All right. We are live now. I really apologize because I had some technical issues with this software. It's the second time I use this OBS and I don't understand really well how to use it. But I think we are live now. Please tell me if you guys can hear me well. Last episode we talk about Dallas, the big state, the Lone Star State, Dallas. Texas, excuse me. We talk about industrial properties in Dallas. We analyze a property, small property in the Dallas market. But now we are turning to the sunny state, to the Arizona, to the Phoenix city, and we are trying to analyze a property there. Uh, so we have the CoStar again, and we are going to analyze this exciting market where recently, like 2 years ago, a huge company from Taiwan Semiconductors invested in Phoenix, starting a new era for industrial supply chains for semiconductors in the West Coast. We have in Phoenix, we are very close to the San Diego area, and also we are very close to the Los Angeles port, which is one of the biggest ports in the U.S. Uh, we have some drawbacks because of the tariffs of the new government that imposes over China, but we are also seeing we can turn or view to the south to Mexico, and maybe some production from China could be turning to Tijuana or some of other southern states in Mexico and enter through this exciting market in Arizona. So let's start with it. Let me show you my screen, guys. And we have again this amazing software, CoStar. We are gonna deep through in the Phoenix market, but before that, I want to show you some of the market statistics of this of the Phoenix industrial market specifically. So let's go to find the market of Phoenix. So the first thing we can see is we in this software in CoStar we only have one market. We don't have sub markets like in Dallas, because Dallas is a huge market, and we have sub markets like in the southeast or close to the airport, to the Dallas Fort Worth airport. But here in CoStar we only can see only one market, because Phoenix is, it's not like a big metropolitan area like Dallas Fort Worth, but it's really interesting market also, not only for the because it's close to Los Angeles in the south of Mexico, but it's also a local market by itself, very interesting because it's growing like I think the last year it was growing by 80,000 people moving into that to Phoenix. So apparently these big companies like the Taiwan semiconductors that invested like 2 or 4 years ago, they are pulling many people to go live in Arizona or in Phoenix, and we have many established universities, many recognized universities, like for example we have the Arizona State University, and we are going to see many high value paid jobs starting to grow in this market. So let's see some analytics. So for example, uh, I have a summary here of the Dallas market, and for example, we can see on the last year, on the last 12 months, we see uh, we see 23 million square feet deliveries. Well, you know, it's the same thing as Dallas since the 22, 21, 22. You know, the pandemic. We start to see many developers starting to build new facilities, new buildings, industrial buildings in the area, and after that we see an oversupply. That's where we are. We saw an oversupply, but also we are experiencing a high net absorption. For example, we have, as I told you, 23.5 million deliveries last year, but we also have the a net absorption of almost 50 million square feet. For a market that small like Phoenix, it's a huge absorption. But the vacancy rate, because of these new deliveries and oversupply that we experienced in the last years, we see a vacancy rate of around 12.4%. You know, but anyway, we are seeing some high vacancy rate. We see high net growth. Excuse me. We see rent growth over the inflation, guys. We see a net rent growth over year 4.3%. So it means even we have a high vacancy rate as 12% because of all the oversupply, we see the rents growing. That's a good signal, guys. But we see maybe this is still a buyer's market, but as the CoStar report says, maybe in the next year or in the 2027, we will see this market stop being a buyer's market, and maybe it turns to a seller's market. So for example, let's say sales volume. We have a sales volume last year of $5.5 billion. $5.5 billion, guys. So, for example, the market rate of the industrial assets per square feet, it's almost $13. It's just the average, guys. And the market sale price per square feet, it's $183. We can see the most interest of the institutional investors here, of the big guys, the big whales, in the over 100,000 square feet new developments. They are not going to they are not going for the small bay industrial warehouses, but they are going for the over 100,000 square feet. So, but as I told you before, we see an opportunity in the locals, because as I told you in the last episode in Dallas, it's the same thing, guys. I'm gonna confess you something. There's an opportunity here. Why? Because the big guys are going for the 100,000 and over warehouses, but they are letting the small bay warehouses for the small guys. And there's an opportunity here because the rents in this kind of warehouses are more expensive than on the by square feet that on the bigger warehouses. So, and also The vacancy is less. It's around, let me see, I think it's around 6%. So it's half of the vacancy on the big warehouses. So we see an opportunity here, guys. Okay, let me see. Okay, so as I told you, this is, let's see some data about the capital markets, about the sales, guys. Let me see here. I have my brief report here, because there's a lot of data here. So you can see, for example, the leasing. We can see the graph, the forecast of the absorption. We can see the absorption. It's starting to decrease. I mean, the vacancy. The vacancy, as I told you, is starting to decrease the next year, guys. So the absorption, it's increasing until 27. Until 27, we have positive. We have a growing absorption. You know, so we are seeing this market like stabilize in the next year or maybe 2 years. So if you buy, if you invest in today, there's still an opportunity because it's a buyer's market. But maybe in the next year or in the 2027, it will be not a buyer's market. It will turn against, and it will be a seller's market. So we can see, for example, the vacancy rates here in the logistics. There's one thing, guys. Logistics. Even I told you that semiconductors here or high tech industries here are a big thing here. There's also logistics. 3PL, as they say, it's three-party logistics. What is third-party logistics? It's like for example, the bigger one, it's Amazon. Amazon, there are many people, many companies that doesn't want to have their own distribution centers, so they leave all those logistics, like fulfillment and all logistics, to third parties. So there are many, because we are very close to Los Angeles, guys. We are very close to Los Angeles, and we are also very close to San Diego. So there's a huge market on the west coast, but Arizona and Phoenix, it's cheaper, way cheaper than Los Angeles, for example. So if you move just one state or two states to the right, to the east, we have lower rents than in California. We have lower wages. We have cheaper transportation cost. So many logistics companies, instead of moving to the west, to Los Angeles, to San Diego, to California, they are moving to markets like Phoenix, or maybe like Las Vegas, or even like Tucson, you know. So we have a huge market for logistics also, and also for specialized manufacturing. It's like I told you, like for the semiconductors. But because why this growing on the semiconductors and specialized manufacturing? Because of the tariffs. Because there are it's a priority for the U.S. governments to develop its own semiconductors industry, because it's a national security issue. You know, what if you what will happen if the U.S. will get out of semiconductors? Everything works with semiconductors, with chips and those kind of things. So the government is trying to reshore the manufacturing of those things from Taiwan, from China, from Japan, all over the US again, you know. And Phoenix is a good place in Arizona because of the universities, because of they are close to the West Coast, to huge markets on the West Coast, and huge port like Los Angeles, you know. And we have a really skilled workforce in the area, in good universities. So we have this new. Okay, I think my image it's okay. Frozen. Let me see. Oh, I told you guys I'm not. Um, Let me fix this. I'm sorry about that, but okay. I hope you can see me. You can see me well now. Okay. So what I was talking about. Okay, yeah, we have a huge market here in Phoenix. Vacancy. We see the vacancy rate for logistics dropping after 25. Yeah, the flex. Maybe the flex. It's the vacancy. It's going up after. So maybe it's not a good time to invest in logistics, in flex buildings. I mean, but for logistics and also for specialized manufacturing, like these high tech industries, I think it's a very good time to invest in. And as I told you, and in 1 or 2 years, the market will turn on a seller's market. Availability. Let's see. Uh, Sublet. We are seeing sublet. Some sublet available. Okay. When we see sublet racing, may mean two things. One, uh, it's a lack of space, you know, because why we see sublet rising, because we see, for example, one company uh, leasing one big space like 100,000 square feet space, and then they don't use all the space, so they have to sublease it. Okay, so they probably use only half. So they because the owner want to lease all for one tenant. He leases all the space, and then the company that leases this space subleases the half of it. So we may see uh, many companies moving and then trying to sublease some space. That's why. Or the other thing that may indicate a growing non sublease, the other cause may be that the companies are not doing well. You know, they are reducing operations, and they are trying to get over those extra space to get more revenue or less expenses. So, but in this thing, what happens is, I think it's not the second one. I think it's the first one. You know, the companies are moving because they see an opportunity to move to this market, but they are not using all the space, so they are trying to get over those that extra space. Okay, so the vacancy it's dropping in the next years, and as you see the market asking rate, for example, in 5 years it will be around 16, almost 17 per square feet. Okay, let me see. Okay, months on the market, months to lease, months vacant. Okay, we see it's the average 6 months, 5 6 months. Probability of leasing 2 or 3 months, 50%. So that means 2.3 months. So that means in 2 months, it's 50% probability that you will lease the space if you if you invest something or you build something. That's the probability. So daily asking rent, okay, market asking rent, growing, asking rent per square feet, growing, construction. As I told you, construction after 2021, a lot of construction then dropping. As all the it's the same thing in Dallas or in all the industrial markets in the U.S. They got into the hype of building, and then we are trying to absorb this extra space, but in the next 2 years it will stabilize, I think. Deliveries and demolitions under construction dropping because oversupply, as I already told you. Sale price per square feet, okay. Market cap rate, this is important, guys. Market cap rate dropping. You see what I told you. Next 2 years, the peak, and then dropping. That's good for investors, guys. It's compressing. Why? Because we are with the oversupply. We in 2 years we are already absorbed it, and the forecast for the U.S. economy is dropping tax rates. Dropping Fed rates. So if the Fed rates drop, all the commercial real estate gets affected and follows up dropping the rates, the cap rates, because we compete to other instruments like bonds or those kind of things that it's correlated. Okay. Let me see here in my brief. Investment activity, we see many significant transactions. For example, one transaction last year, 147 million for Park 303 Phase 2. Dollar Tree was the buyer on September. This is this year, man. This is this year, guys. September 2025, 150 millions. That's the largest in the 12 months. GLL, also a big buyer, 140 millions. Okay. And BGO, JP Morgan, okay, market players, Prologis. This is a big market. This is a big players market, guys. I just want to let you know this is a big place, but there's a niche, as in Dallas, for the 50 and less square feet warehouses. So let's get deep into the information about the properties. Let's find. I just don't wanna take too much time in this because I already started late. But let me show you some about the market. Let's see, Phoenix. Oh, guys, yeah, this I'm not really like a very proficient using this new software for broadcasting. Oh, last time it was easier last time, but this time it got frozen and many problems I had with the software, guys. But as I promised, I'm here late, but I'm here. Okay, so let's say for lease. Let's choose for lease, and let's say industrial. We are not looking for flex this time because we already see flex vacancy it's rising. So we are gonna invest this time in industrial, guys. and we are going to see some. Let's just imagine we are big whales. We have large amounts of money, and we are going to purchase a 100 and over square feet warehouse. Okay, so last time in Dallas we searched for small warehouses, but this time we are going to be looking for bigger deals. We are big whales, remember. So let's see, excuse me, let's see, minimum square feet 100 square feet and over, guys. So we have 86 properties, guys. Okay, so let's see, let me show you this map. It's Google Maps. Okay, let's see just an aerial view of Phoenix to see how it is connected with San Diego and Los Angeles. For example, to the west we have the 10 highway to Los Angeles, you see, and we have the 8 to the south. Okay, and then we have a connection with Tucson, and we also have a connection with the 8 to Mexicali and Tijuana. Okay, so probably we are choosing something on the west, on this area, you know, because we are if 60%, I think 60% of the deals last year were from logistics. That means it is probably attending the California market, you know, the Los Angeles. So probably we are shopping something on this side, on the 10 highway. We are going for something in logistics, guys. Maybe there's opportunity also here for data centers, because you know, but probably data centers are as I have seen, for example, the Amazon data centers, they are on the west, on the Los Angeles, or those cities. So but probably we have some opportunities for data centers, but let's invest this time in logistics. I think it's a promising market, guys. So let's see here, this, let's choose this area. Shows like this is like there are many big warehouses concentrated in this area. So we are gonna draw a radius here. Let's reduce or market, and now we have 31 properties, guys. So let's see, we can sort the properties by property types, square feet available, guys, or let's see, square feet available, for sale, building name, property. Let's see, by gross leasing area. Okay, okay, okay. Okay, looks like it is sorted now. Okay, so let's say, let's choose 3 properties. Let's choose the first one, is the biggest one, the Dysa Road and Peoria Avenue, 1,200,000 square feet. Oh, but this looks like for sale. It's a proposed building. So let's filter up. Let me show you some other filter. Building. We don't want proposed. We want something that is already built. Okay. So let's say existing building. We have now 18 properties. Okay. Secondary time. Build. Let's say we have something new. So we want something, okay, that was built in from 2023. Okay, so we are looking for something new, guys. Okay, so we have 18 properties, existing building and brand new. Okay, so select. Okay, so let's select this one, that is the biggest one. Let's select this one, and let's say want something on the 100 or 200 maybe. Okay, 61N. Okay, let me see the biggest, and then some medium, like this one. Well, okay, 3 selected. Okay, so we have 3 options, guys. The biggest one, it's 500,000 square feet, distribution center, built in 2024. Then we have 250,000 square feet, distribution, built last year, also 2024. Okay, and we have the smallest one, it's 155, warehouse. This is a warehouse built this year. Okay, so let's let let me know what which one do you want me to choose, the big one, the medium, or the small one. Let me show me on the comments. I will give you 1 minute to vote. Large, medium, or small? Which one do you want? We are rich, remember, we are big guys, and we have large amounts of money. So sky is the limit. Okay, ready, guys? Are you ready? Show me in the comments, one comment. Let me know. Okay. Okay, guys. Let's choose the middle one. Let's choose the middle one. That one, I don't think I have too much money. I want to invest at least in two, guys. I will confess you, because 100 and half million square feet is too much. Too much. You have to diversify. Even if you are a big whale, even if you are a big investor, you have to diversify. You can choose a big one, half a million square feet, because you don't have to put all your eggs in one basket, guys. So let's choose the middle one. The small one, it's a warehouse. I don't like. We analyzed, I think, a warehouse last time in Dallas. So this time I really want to see the something about distribution of logistics. So this one seems good. So let's see more about this property, guys. Okay. Okay, let's see, guys. Let's see. Okay, so we have a gross building area, a rentable area of 245 square feet, 1,000 square feet. Okay, and we have a lot of almost 18 acres built in 2024. Okay, and we have available up to the gross building area, up to the rentable area, that is 245,000 square feet. CoStar, what's the estimated rent for CoStar? 10 to 30 bucks per square feet. Sale price not disclosed, guys. Usually these big guys, they don't disclose the price, because you have some competitors, and when you are selling these big warehouses or big buildings, big industrial buildings, you don't want that your investors or your leads go see your price, and then they think it's too expensive and then go to your competitors. So you may do not disclose the price, and they usually call you, and you don't, everything is negotiable here. Everything is negotiable. Even the commercial, they always say you commercial, it's just numbers, it's just formulas, and you divide NOI by the cap rate, and you have the price. That's totally false, guys. Everything is negotiable here. So even you have some cap rate or NOI, that doesn't mean you cannot negotiate. And even it's more negotiable if you don't have cash flow here, because you have only pro formas. You have only forecast of the revenue, of the income, So when you have, that's because it's better to, before selling a commercial property, it's better to rent it out, because otherwise, if you don't rent it out, you have more you give your investor or your buyer more field to negotiate. If you rent it out and you have a cash flow, then the window for negotiation, it's not as wide as if you don't have cash flow. So we see here the available space. It's up to the rent, up to the building area, so that means it's not leased, you know, or maybe it's not leased at 100%. And also we see the average the average uh, excuse me, the the average vacancy in for big buildings, it's around, I think, 12% in this market. So that means you will not lease it all the time or all the space. So it's one story. We have 46 exterior docks. Let's see the images. You see, when you have logistics, when you have this big warehouse for logistics, you almost always have one high docks, okay? Because with high docks, it's easier to load all your trucks and get it on the road. You know, when you have a small, like last mile distributions, like those distributions that when your trucks go to the city to sell to the retailers, you better ask for ramps, because those kind of trucks are small trucks. But when you have like a distribution, like in this case, we are looking for the west market for San Diego, for Los Angeles, we better ask for high deck, you know. So we see here 4 ramps, you know, and the rest maybe probably here, or maybe here, no, here we have high decks, high docks, okay. $46, okay. Drive-ins, that's what I'm telling guys. I'm telling you guys, we have 4 ramps. This is for maybe it's even if you have a distribution center that you are looking for external for other exterior markets like Los Angeles, it's always good to have some ramps, you know, because sometimes you have to give some maintenance here, or maybe you have to get get into the building some kind of I don't know, like a crane or something, but it's more like for the maintenance than for distribution. For distribution you need the high decks here, okay. So industrial property mix, industrial, office, that means the most of the space here it's industrial, and we already have some office. But you know, you can always negotiate those kind of improvements when you lease your property. When you, let's say we buy this warehouse, but let's say we have a lead, we have a prospect that wants a bigger office, okay. They want to build a mezzanine with a let's say 20,000 square feet office. What we do in this case, you know, he can build it, but usually the tenant asks you for tenant improvements allowances. That means you as the owner, they say, okay, I'm gonna rent you let's say $13 per square feet, okay, but then you are gonna pay me for the improvements. You are gonna pay me for to build a mezzanine here and to build my office. I want a 20,000 square feet office here. being built. Okay, so you are gonna pay for it. I'm gonna pay you the biggest amount of rent, but you are gonna pay for my office, and you agree. Let's say you agree. So that means these 13 US dollars per square feet may reshape to a $10 or maybe $11 per square feet, because that doesn't mean you have to pay for the improvements, okay? But you get the rent reduced, okay, with the tenant improvements. So you have to negotiate always. That's what I say. All it's negotiable, guys. So that doesn't means if the rent, that this is other reason, because the owner doesn't disclose the numbers, because there are many moving parts in the lease agreement and also in the sale agreement that you can negotiate. For example, in the rent you can negotiate the tenant improvements, you can negotiate recovery of utilities, recovery of maintenance, you can negotiate recovery of taxes, so it's better to not disclose too much things when you are selling or when you are leasing out. Okay, so we see the seller, the owner is Invesco. Invesco, it's a big investor company, so that means this is that means actually it's a spec building. It's another thing I didn't told you. The most of the buildings here in this market in Phoenix are spec buildings. At least the most being developed right now are spec buildings. There are two types of buildings on by the if you name it by the tenant needs. There are two types. The spec buildings is when you don't have a tenant when you invest in. That's what they say speculative. You first invest, you go to the bank, they lend you money, but you don't have the tenant already. You don't have a rent, so it's riskier. Okay, it's riskier for the investor. But there's other kind of buildings that they are named build to suit. Build to suit buildings are you make the things, the development in the opposite. You turn all the business model. You first get the tenant, and then the tenant tells you, okay, I need, let's say, 100,000 square feet for my new plant. Let's say Tesla, and you are a developer, and they go with you and they told you, I need 100,000 square feet for my new how they call the plants, the mega factory. 100,000 square feet for my new, I think they ask for 1 million or more, but let's say this is a small mega factory. So they ask you for I need 100,000. You will build it, and I will pay you, let's say, $15. I will pay you more. I will pay you $15, and I will sign a lease agreement for 10 years. 10 years, $15, and we will increase, let's say, 5% every year. Okay, so you say, oh, it's a big deal, guys. It's a big deal because you have a 10 lease term already signed. You have the rent already agreed before you put the first brick. So if you have the lease signed first, you then go to the bank and you say, okay, let's say Bank of America, okay, I have this tenant. I have Elon Musk just signed me this lease, for 10 years, and he's gonna pay me $15 per square feet for a 100 square feet building. Now it's the bad part. I need, let's say, $100 million to build this building, this new building. So they say, okay, you have Tesla. Tesla is a good company. You have, you know, you have a 10 lease agreement, and you have this rent per square feet. So your cash flow will be this, and based on the tenant credit and on the lease you have, they will give you the money to build that building, you know, before you risk any money. Okay, so those are the best deals, the build to suit, but those are reserved for the big guys, you know, because also the bank will not just lend you the money because you signed a lease with Elon Musk, you know. They will ask you for your track record, you know. If you are like a novel developer, they will not lend you money because you can mess it out, you know. So but between those kind of buildings, the build to suit or the spec, if I have the to choose, I will choose the build to suit. It's the least riskier and the best return. Okay. So okay, so we have okay, let's say vacancy rates 100% vacant. Okay, well, this is market conditions. Submarket 24%. Okay, market asking rent $8. Okay, sales volume in the area 1 billion. It's an area, it's a fast moving area. 1 billion sales last year. Okay, so let's see lease. They don't have any tenants, so they don't have any cash flow. Okay. Okay, use industrial. Okay, they have one. Okay, one leasing. Lease analysis. Let's see peers. We have many competitors, many new buildings here. Okay, those are bigger buildings. Tenant. We don't have any tenant here. Sale. Okay, so we don't have any you know, financials, let's say income. This is for the market, showing for the market, the Phoenix market. Okay, effective gross income, okay, 21, operating expenses 6. So we have around 30% OPEX rate. 14, net operating income. Cash flow 14. Okay. So we have around 30% operating expenses rate. That's the important data we have to get from here. That's for the market, guys. And for a new building, it's comprehensible that new buildings have less expenses than old buildings. So maybe 25, maybe 30% operating expenses. It's and also for a bigger building, it's less. And there's one trick here. For the industrial buildings, we usually sign triple net leases. That what's a triple net lease? You probably, if you have a property and rent it out like a single family home, you receive your rent and you pay your taxes, you pay maintenance. If a toilet gets broken, you go fix it. And the tenant only pays his own utilities. Okay, but you pay the taxes, you pay the maintenance, and you pay the insurance of the property. Okay, so those are the triple nets of a lease: the maintenance, the insurance, and the maintenance, insurance, and taxes. Okay, so in triple net, that's a gross lease. In triple net leases, you can pay those expenses, but the tenant will get refunded by the tenant if it's a triple net. Okay, so for example, if you have here a triple net 13 square feet, $13 per square feet, that means you will receive $13 per square feet, but also you will get refunded for the taxes, for the maintenance, and for the insurance. Okay, so that means your NOI grows. Okay, because you have less expenses. Okay, and if you, as I told you last episode, if your NOI grows, your property value automatically grows. Okay, because of the formula, you have NOI divided by cap rate. So if you have a bigger NOI because you have less expenses, then you have your property costs more, it's valued more. Okay, so let's see the demographics here. Everything is important, guys. Don't think because it's in an industrial property it's not important to see the demographics, because you may think, okay, demographics is just for retail, or it's just for multifamily, that you want to see how your tenant will be. But not, guys, you have to see the demographic, because if you want to invest in a big warehouse or distribution building for a big company, you have to think as a tenant. Well, he will need workforce in this particular market in Phoenix. We need a skilled workforce. Okay, at least if it's a specialized manufacturing. Okay, you will. It's more important that you see the demographics, because that tenant, that company that rents your warehouse, will need a skilled workforce. So, and in logistics maybe it's not that important, but you also have to look for a blue collar workers in the area. Okay, because if, for example, you are selling our logistics, you are investing in logistics building, but the area where you are investing, it's very far to where blue collar people or jobs lives. The the workers are having a hard time, you know, in the commuting to the job, you know. So you always have to, for example, here in logistics, you have to make sure you have blue collar jobs close to here. Okay. So for example, we see average household income here. You know, it's high. It's high. It's usually not blue collars here. You know, let's see housing population by age, but we see the age it's 25 in 5 miles. 25, this is the like the preferred blue collar age, employees, excuse me. So we see a large and a growing demographics for the working age people. You know, most bachelor's degree, high school and graduate, some college. Okay, so this is probably a high income area. So probably blue collar jobs are not that close to this property. Okay, household income by age, household income. You know, probably blue collar jobs will be like this and this demographics: 25 to 50 and 50 to 75. Okay, but it's not that bad. It's not that bad. We have okay, home values. We can also see if we are close to blue collar jobs, to blue collar workers here in the values of their homes. You see, 200 to 3. Usually these are the houses for blue collar workers. It's we see we have some, but most are for high earners. Housing types. Okay, 1 unit. So it looks like this is a high income area. Okay, but if we don't have like, okay, we see here daytime employment, service, professional business. Okay, manufacturing. Okay, not many manufacturing. Okay, okay, we see here, for example, the most of the workers are education and wealth services. That's where it's a high income or medium to high income, let's say, area. But we have some on the trade and transportation. So probably we have enough workers close to here, at least on 10 miles. But in 5 miles, we have some also 4,000 employing. So we will be, we see we have a lot of competition here, other buildings here. So we have to be sure that we are connected to highways here, to the low or middle income areas, so we can have employees that travel from their houses to our warehouse or building. Okay, we have to make sure that's something we have to make sure. Okay, public records, image. Okay, so here, let's see. So let's I don't want to take more of your time, guys. Let's say we have here, there's one thing with this. Let me see the list analysis financials. Okay, What I told you with the expense reimbursement. That means for the for a triple net. When you have a triple net, you have expense reimbursement. Okay, parking income, some parking income. So let's say we have this 13 plus 7, so we have a 20 per square feet rent. Okay, effective rent. So we have 250 almost square feet. Okay, so gross rent will be that number by 20. Okay, by 20 we have a vacancy of, let's say, 12 as the market. OPEX multiple, let's say we have a 30%, 33%, let's say 30%. Okay, so we have a gross rent of 4 million annual. Okay, 4 million. Let's get the value on the cap rate. Only on the cap rate this time. We are not doing on the cash flow, just to be fast. So let's say the cap rate, I don't remember what was the cap rate on this market, but for the bigger properties, I think it was 6%. So the value for cap rate, and let's say as it is new, this is important, guys. So when in the other property in Dallas, we say, I remember the cap rate when grow from the first cap rate. Okay, because it gets I'm sorry, in the Dallas property, it got compressed, but this time the cap rate will grow. Why it will grow? Because the property will get older. If the property gets older, usually you have more operating expenses. Okay, and that means your profit is less. So when you sell the property, that it's reflected on the cap rate. Okay, so because of that, let's say it will grow to 0.63. Okay, but for the cap rate, it's only the formula. It's the cash flow, the cash flow on the first year, the NOI, yeah, divided by the cap rate on the market. So approximately this property is valued at 50 million. Okay, approximately. So if you make by cash flow, maybe it will vary the value of the property. And also, as I told you before, when you have a property with cash flow, it values more because you reduce the risk for the investor. It's valued more, so if you develop a property, you first try it, or you invest in a property and you fix it up or raise the rents, first try it to rent it out for at least 1 year, because that gives you the opportunity to get some profit and loss statements from the property. And that means you are having solid numbers. Otherwise, if you have pro formas, a pro forma may be or may not be. So it's better that if you invest in a property and you plan in a property that it's vacant or you are going to improve, you first, after you improve it, you first rent it out for at least 1 year. Okay, because that will let you to sell the property for more. Okay, so guys, I hope I'm really apologize. Let me. Okay. 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 Oh, I'm frozen here. Wait a minute, a little bit. Okay. Okay, I think I'm good. Okay, so guys, thank you for being here. I really apologize because this time I really had problems with the software. I'm gonna try to change this software for other kind of streaming software because I have many maybe problems with this. But thank you guys. I really thank you that you uh, watch this live stream, and please, if you really enjoy it, ask me anything. If you have any question, we can schedule a call, a free call, 30 minutes call. If you want to invest in the US, if you want to, maybe you are a foreign investor. Maybe you live in the UK, or maybe you live in Australia, or maybe in Dubai, and you want to invest in a property, in industrial property, maybe in an office property, or even a multifamily here in the US. We can have a conversation, a totally free conversation, and I will give you some uh, counsel and some. I will tell you how to buy the property, or to develop your strategy here in the US. And also, if you are a foreigner, I have a webinar. I will give you the link. I will write the link on the description. And and also, if you want to follow me and stay in touch with me, you can follow me on my YouTube channel, the Nearshoring Team. And also, you can follow me on Instagram as well, the Nearshoring Team. Or you can find me on LinkedIn, and you can send me a message, you can call me, uh, whatever you want, guys. I just want to help investors. I just want to help uh, people to invest in this magnificent country that has, it's full of opportunities here. And also, if you have a company and you want to rent something, I can help you as well with tenant representation. I can help you to negotiate the leasing agreements with the owner. Just call me or stay in touch. And thank you guys for being here in this live stream, and see you in the next episode. Thank you. Bye.